Welcome back to XRP Economic Radar, your trusted source for the latest developments shaping the cryptocurrency market and the future of digital finance. Today, we have a major story that is generating excitement across the crypto industry and drawing attention from both retail traders and institutional investors. Bitcoin, XRP, Cardano, Stellar, Solana, and several other leading digital assets have officially entered CME Group's brand new Nasdaq CME Crypto Index Futures product. This is not just another launch in the derivatives market. Many analysts are viewing it as another significant step toward broader institutional adoption of cryptocurrencies. As traditional financial giants continue building regulated pathways into the digital asset sector, products like this can potentially reshape how large investors gain exposure to crypto markets. The inclusion of XRP, ADA, XLM, and SOL alongside Bitcoin and Ether is particularly notable because it signals growing recognition of these assets within regulated financial infrastructure. Throughout this report, we'll break down exactly what this launch means, why investors are paying attention, and how it could impact the future of the crypto ecosystem. CME Group announced the launch of Nasdaq CME Crypto Index Futures as part of its expanding lineup of regulated cryptocurrency derivatives. Unlike traditional crypto futures that focus on a single digital asset, this new product is tied to a diversified basket of major cryptocurrencies. The index tracks some of the largest and most actively traded digital assets in the market today. As of June 9th, the basket includes Bitcoin, Bitcoin Cash, Ether, Solana, XRP, Cardano, Chainlink, and Stellar Lumens. This means investors can now gain exposure to multiple cryptocurrencies through a single futures contract instead of managing several separate positions. That distinction is important because diversification has long been a key strategy in traditional investing. Rather than betting on one individual cryptocurrency, investors can participate in the broader market through one regulated instrument. For institutions that prioritize efficiency, compliance, and risk management, this approach may be far more attractive than maintaining exposure across numerous individual crypto products. The launch demonstrates how rapidly the digital asset market is maturing and becoming integrated with traditional financial systems. One of the most interesting aspects of this new product is that it is financially settled at expiration using the Nasdaq CME Crypto Settlement Price Index. In simple terms, traders do not receive actual cryptocurrencies when contracts expire. Instead, settlements occur in cash based on the value of the underlying index. This structure is familiar to institutional participants and aligns with how many traditional futures products operate. For large financial firms, pension funds, hedge funds, and asset managers, cash-settled products often provide greater convenience and reduce operational complexities associated with holding and securing digital assets directly. The settlement process removes concerns about custody solutions, wallet security, and asset transfers, while still allowing participants to gain exposure to crypto price movements. This regulated framework is one reason institutional adoption has accelerated in recent years. As traditional finance seeks safer and more structured access points into the crypto sector, products like these create a bridge between conventional markets and digital assets, making participation more accessible to a wider range of professional investors. The inclusion of XRP in this index is especially noteworthy for members of the XRP community. For years, XRP supporters have argued that institutional recognition would eventually expand beyond Bitcoin and Ethereum. Now, XRP stands alongside some of the industry's most prominent cryptocurrencies within a regulated futures product tied to a major financial benchmark. While this does not mean direct XRP futures contracts are being replaced or expanded, it does provide another layer of visibility and legitimacy. Institutional investors who may have previously focused only on Bitcoin and Ether can now gain indirect exposure to XRP through the broader basket. That exposure may seem small at first glance, but inclusion in regulated financial products often contributes to greater awareness, increased research coverage, and deeper market participation over time. For many XRP holders, this development represents another signal that the asset is continuing to strengthen its position within the evolving digital asset landscape, especially as traditional financial institutions become more comfortable incorporating cryptocurrency exposure into their investment strategies. Cardano and Stellar are also receiving significant attention following this announcement. Both ADA and XLM have long maintained dedicated communities and have established themselves as important projects within the blockchain ecosystem. Their inclusion in CME's new Nasdaq Crypto Index Futures demonstrates that market relevance extends beyond daily headlines and social media discussions. Institutional products generally undergo rigorous evaluation before launch, and asset selection is often based on liquidity, market participation, trading activity, and overall significance within the industry. By appearing in the same basket as Bitcoin, Ether, Solana, XRP, and Chainlink, Cardano and Stellar gain additional validation from a market structure perspective. This recognition could encourage more institutional research, potentially driving greater understanding of the technologies and ecosystems behind these projects. While inclusion alone does not guarantee price appreciation, it does place these digital assets in front of a broader audience of investors who may have previously focused their attention elsewhere. Solana's presence in the index is equally significant given its rapid growth over recent years. Solana has become one of the most actively discussed blockchain networks in the cryptocurrency industry, attracting developers, decentralized finance applications, NFT projects, and institutional interest. Being included in a regulated multi-asset futures index further strengthens its standing among major digital assets. Investors looking for diversified crypto exposure now receive Solana representation alongside more established names such as Bitcoin and Ether. This reflects the growing influence of alternative Layer 1 blockchain networks and highlights how market participants increasingly view the crypto ecosystem as much broader than just the original cryptocurrencies. Solana's inclusion also reinforces the idea that institutional investors are seeking access to innovation occurring across different blockchain ecosystems, rather than concentrating exclusively on a handful of legacy assets. As the digital asset market continues evolving, diversified exposure may become an increasingly important strategy for participants navigating the rapidly changing landscape. According to CME Group, the primary objective of this new futures product is to provide diversified crypto exposure while preserving the transparency, capital efficiency, and risk management advantages associated with regulated futures markets. This approach directly addresses one of the concerns often raised by institutional investors. Crypto markets can experience substantial volatility, and managing exposure across multiple individual assets can be operationally challenging. A single futures contract tied to a basket of major cryptocurrencies offers a potentially more streamlined solution. Investors can gain broad market exposure without opening and maintaining numerous positions. Risk managers can monitor one instrument rather than several separate contracts. Compliance teams can operate within a familiar regulatory framework. These advantages help explain why regulated crypto derivatives continue attracting institutional attention despite ongoing volatility across digital asset markets. As the industry matures, products that simplify access while maintaining regulatory oversight are likely to play an increasingly important role in encouraging broader participation. Giovanni Vizioso, CME Group's global head of cryptocurrency products, described the launch as a significant milestone in the ongoing expansion of CME's regulated digital asset marketplace. His comments highlight an important trend that has become increasingly evident over the past few years. Investors are no longer looking exclusively for exposure to individual cryptocurrencies. Instead, many are seeking diversified participation across the broader digital asset ecosystem. During periods of heightened market volatility, diversification can serve as an important risk management tool. Rather than relying on the performance of a single asset, investors gain exposure to multiple projects representing different segments of the cryptocurrency industry. Vizioso emphasized that market participants want this exposure while maintaining access to regulated infrastructure. That statement reflects the growing convergence between traditional finance and digital assets, where investors increasingly expect the same standards of transparency, governance, and oversight that exist in other established financial markets. Nasdaq also expressed confidence in the growing importance of crypto benchmark products. Sean Wasserman noted that investor participation in digital assets continues increasing, and that demand for transparent, well-governed benchmarks is growing alongside it. This observation speaks to a broader evolution occurring throughout the crypto industry. In earlier years, cryptocurrency investing often operated outside traditional financial frameworks. Today, however, major financial institutions are building products that mirror the structures used across equities, commodities, and fixed income markets. Benchmark indexes play a critical role in this process because they provide standardized reference points for investment products, performance measurement, and risk management. As institutional involvement expands, reliable benchmarks become increasingly important. The launch of futures linked to a diversified crypto index represents another step toward integrating digital assets into mainstream financial infrastructure and creating tools that investors can use with greater confidence. This latest launch also builds upon CME's already substantial crypto derivatives business. The exchange has spent years expanding its offerings beyond traditional asset classes and establishing itself as one of the leading regulated venues for cryptocurrency-related products. Bitcoin and Ether futures helped create institutional access points for digital assets, and CME later introduced microcontracts and options products to meet evolving demand. Each expansion has reflected growing interest from professional investors seeking regulated exposure to cryptocurrencies. The Nasdaq CME Crypto Index futures represent the next phase of that evolution by shifting attention from single asset products toward broader market participation. Rather than focusing exclusively on Bitcoin or Ether, investors now have access to a diversified basket that captures multiple segments of the crypto ecosystem. This progression mirrors developments in traditional finance, where index-based investing became a major component of portfolio construction and risk management. Interestingly, this announcement arrived shortly after CME launched another innovative crypto-related product, Bitcoin Volatility Index Futures. These contracts are linked to the CME CF Bitcoin Volatility Index, commonly known as BVX. Rather than tracking Bitcoin's price direction, the index measures market expectations regarding Bitcoin volatility over the next 4 weeks. This distinction is important because volatility itself has become an asset class within traditional financial markets. Investors do not necessarily need to predict whether Bitcoin will rise or fall. Instead, they can take positions based on expectations regarding the magnitude of future price movements. Such products offer additional flexibility and create new risk management opportunities for market participants navigating an increasingly sophisticated cryptocurrency marketplace. The launch demonstrates how crypto derivatives are evolving beyond simple directional bets and moving toward more advanced financial strategies commonly used in traditional markets. The first block trades in CME's Bitcoin volatility futures were executed by DV Chain and Monarch Asset Management, marking an important milestone for the product's debut. Block trades are often closely watched because they can signal early institutional interest and participation. In this case, the transactions demonstrated that sophisticated market participants are already exploring ways to utilize volatility-based instruments within their investment and risk management strategies. Unlike traditional futures contracts that require investors to take a directional view, volatility futures allow traders to focus on expected market turbulence. This can be particularly useful during periods of economic uncertainty, major policy announcements, inflation reports, or geopolitical developments. Investors may anticipate large price swings without necessarily knowing which direction the market will move. By providing tools that address these scenarios, CME continues expanding the range of products available to institutional participants and reinforcing its position within the rapidly developing crypto derivatives sector. Monarch Asset Management Chief Executive Officer Shiliang Tang emphasized that regulated Bitcoin volatility futures provide another valuable risk management tool as Bitcoin increasingly becomes an institutional asset class. His remarks reflect a reality that has become increasingly clear throughout recent years. Bitcoin is no longer viewed solely as a speculative asset by many market participants. Instead, it is gradually becoming integrated into broader portfolio strategies used by professional investors. As that transition continues, demand for sophisticated hedging tools naturally grows. Institutions often require products that allow them to manage exposure under different market conditions, and volatility futures represent one example of how the crypto derivatives ecosystem is evolving to meet those needs. The broader significance of this trend extends beyond Bitcoin itself. As more advanced products emerge, they contribute to market maturity and create infrastructure that supports greater institutional participation across the digital asset sector. The numbers behind CME's crypto derivatives business further illustrate this growth trajectory. According to reported figures, average daily trading activity reached approximately 266,900 contracts year-to-date, representing a substantial increase compared to the previous year. Open interest also continued climbing, averaging around 274,500 contracts. These figures indicate not only growing participation, but also deeper engagement from market participants maintaining positions over extended periods. Rising open interest is often interpreted as a sign of strengthening market involvement because it reflects capital committed to active contracts. While market conditions can fluctuate significantly, the long-term trend points toward increasing institutional adoption of regulated crypto derivatives. As more investors seek exposure through established financial infrastructure, exchanges like CME are positioned to play a central role in facilitating that demand while maintaining regulatory oversight and standardized risk management practices. Despite the positive momentum surrounding new crypto products, CME leadership has also expressed concerns about certain developments within the industry. Chief Executive Officer Terry Duffy recently criticized the approval of perpetual crypto futures for U.S. markets, warning that these products could introduce systemic risks. Perpetual futures differ from traditional futures contracts because they do not have expiration dates. Traders can maintain positions indefinitely, often using substantial leverage. While this structure has become popular in global cryptocurrency markets, critics argue that excessive leverage can amplify market instability and increase risks for less experienced participants. Duffy's comments highlight an ongoing debate regarding the balance between innovation and investor protection. As regulators and exchanges continue expanding access to digital assets, questions surrounding leverage, risk management, and market stability remain central to discussions about the future direction of the industry. Perpetual futures have attracted significant attention because some platforms offer leverage ratios that can reach 50-to-1 or even higher. Such leverage can dramatically magnify gains, but it can also accelerate losses and trigger rapid liquidations during volatile market conditions. Duffy argued that funding costs, liquidation mechanisms, and leverage structures may create challenges for retail investors who do not fully understand how these products function. His perspective reflects broader concerns that have surfaced repeatedly throughout crypto market cycles. While sophisticated traders may utilize leverage responsibly, inexperienced participants can sometimes underestimate associated risks. As the digital asset sector continues evolving, exchanges and regulators face the challenge of encouraging innovation while maintaining safeguards that promote market stability and investor protection. The discussion became even more relevant after Coinbase and Kalshi announced plans to launch perpetual crypto futures following regulatory approval from the Commodity Futures Trading Commission. These approvals represent a significant development because they pave the way for perpetual futures to become available through regulated U.S. venues. Supporters argue that regulated offerings can provide stronger protections and greater transparency compared to offshore alternatives. Critics, however, remain concerned about the risks associated with highly leveraged products. This debate is likely to continue as the crypto industry expands and financial institutions introduce increasingly sophisticated instruments. What remains clear is that the regulatory environment surrounding digital assets is becoming more complex and more important than ever before. As we wrap up today's report, the launch of Nasdaq CME Crypto Index Futures stands out as another major milestone in the ongoing institutionalization of digital assets. The inclusion of Bitcoin, XRP, Cardano, Stellar, Solana, Chainlink, Ether, and Bitcoin Cash within a single regulated futures contract reflects growing demand for diversified crypto exposure and highlights the expanding role of digital assets within mainstream finance. For XRP supporters, the news represents another meaningful step toward broader institutional visibility. For the wider crypto market, it demonstrates that traditional financial infrastructure continues embracing digital assets through increasingly sophisticated and regulated products. Whether you are a trader, investor, or simply following the evolution of blockchain technology, these developments are worth watching closely because they may help shape the next phase of cryptocurrency adoption. Thank you for watching XRP Economic Radar. If you enjoyed this update, make sure to subscribe, stay informed, and join us again for more breaking news and market insights from the world of crypto.